Now we'll look at some of the main statements that comprise the income statement, balance sheet, etc. We'll start with the income statement, which is usually the one people look at first. Here we have 3 years presented for the years ended December 31st, 2016, 17, and 18. And we see a fairly simple looking income statement. There are many that are far more complicated, but let's make it even more simplified by extracting from the left actual statements to some of the key numbers just to get, as I mentioned earlier, just a rough feel of how they're doing. So we see that their revenues and net income are substantial, $70 billion in revenues for 2018, on which they made $21 billion. Their profit margin, and this is a preview and ratio, if you divide the net income by the revenues, you get a percentage. And this percentage for 2018 is 29.7. Translated, that means for every dollar of sales that Intel has, they earn $29.70, compared to the prior year where they earned 15. So Intel should be proud that in 1 year they almost doubled their profit rate. And this is a high-level introduction to income statement, but we can go a little bit further. The next step we're going to do is do a deeper dive, and we'll pull up the Excel sheet that has the income statement, and I'll make comments all along the way. So next we'll go to the Excel form where we can do a little more detailed analysis of our first pass through Intel's income statement. All right, so what I've done is taken the income statement and simplified it a bit to take out some of the more technical jargon, and that enables us to go from top to bottom and see what's going on. On the top of the income statement, we start with revenue, and these are sales of products and services. Sometimes you'll see the term revenue, sometimes you'll see the term sales. Most often we see the term revenue. Just think of it as this is the money you get in, and this is from selling products or providing services to customers. Next, you'll see a line called cost of sales. Sometimes it's also called cost of goods sold, so those are used synonymously. Out of the money you earn from selling products or providing services, what did those cost you? You made money, great, but it cost you something to provide that product. Either you manufactured it or you bought it from others, but it doesn't come from nothing, right? So cost of sales represents the cost of the goods sold in the revenue line. When we take the subtotal of revenue minus the cost of goods sold, we'll get gross profit. And that means at the very high level, you sold a chair for $400. It cost you $150. So therefore you earn on that chair $250. And that's what gross profit is. And that's a number that we look at pretty carefully, because the more value added you have as a business, the higher your gross profit will be. If you sold a generic product like flour or salt, the profit margin is not that high. If you sell a very differentiated and proprietary product that you invented, like the latest version of an Apple iPhone, that has a higher profit margin because you can't just buy that anywhere. You have to buy from Apple. So that is an example of where we'd first get a glimpse as to the profitability of the business. Does it have high profit margins or low profit margins? Beyond that, we look at the expenses to run the business. We often call these operating expenses. Sometimes you'll also hear them as called selling, general, and administrative, SG&A. Here in this example, the terminology used by Intel is to break out SG&A, selling, general, and administrative, separate from research and development and other restructuring and other charges. SG&A is what does it cost to run the business. That's pretty straightforward. Next is R&D. You'll note that in Intel's case, they spend a lot of money. That's $13 billion they spend in 2018 on R&D. And restructuring is, and other, are many other things that may occur as companies manage their business, grow their business, and change their business. So these are, in Intel's case, lumped together in one line item called restructuring and other charges. The next row is amortization of acquisition-related intangibles. That's a pretty technical topic, but they may buy the rights to use some invention from another company, the patent rights, if you will. And those rights are going to be spread over a number of years. So if you spent $7 million for the patent rights to use some technology for the next 7 years, what we do is we will expense $1 million per year, because that's the period over which we use the technology. And this is what amortization means, where we take a certain amount of expenditure as an expense as we utilize and get benefit from that particular expenditure. When we take the gross profit and we subtract from it the operating expense, we get operating income. And that's this other next subtotal. I'll just highlight the subtotals as we go, just so you can see how they relate to each other. Gross profit is near the top, and that's just revenue minus cost of goods sold. Then we go to operating income, which is the gross profit minus the operating expense. And that is, think about it as how much money you earn as a business from running the business of Intel. Below it, you see other. And other could be gains and losses from investments that they may have, which is not the main purpose of their business. Their purpose in life is to generate chips that they sell. And maybe not life, MES business. And then interest and other. So interest expense is paid. Notice that interest expense is not in operating expenses. It's below operating income. And the reason for that is interest comes from borrowing money. Borrowing money means you had to borrow money. But what if you had a choice of just raising all the money from selling stock versus borrowing money from the bank or the bond market? Well, then you would have no interest expense. That one frame of mind means that interest expense is not from running the business. Interest expense is from how you finance the business. If you happen to finance it with debt and owe money to, say, a bank, then you have interest expense. If you financed it by raising a lot of money from shareholders, you have no interest expense. So to keep it clean, we want to evaluate the company as an operating business, and that's why we stick all the operating items above operating income, and things that are not related to the running of the business, like interest, below the line of operating. Think of it as financing is not an operating expense. So we end up with the next line item, which is income before tax. And sometimes we call that pre-tax income. Then we subtract income taxes, and we end up with what we frequently call the bottom line, which is net income. So we see that in the case of Intel, in a fairly simplified format, we have revenue minus cost of goods sold is gross profit. We subtract out the cost of running the business, operating expense, and we get operating income. And then we subtract other non-operating expenses, such as gains and losses, interest, and other. And we get pre-tax profit. And from that, we subtract income taxes to get net income. And that is the typical looking income statement that you'll see. Every industry might be slightly different. Companies may choose to explain their business in slightly different, sometimes more general, sometimes more specific ways. But this is the general format of an income statement, leading to what we want to see is how much money did you make? How much did you get in revenue? What were your expenses? And how much money did you make? And that's what we're looking at. The next section here is on earnings per share. We'll use this as well, but it's a very commonly looked at performance metric is for every share of stock outstanding, how much did you earn? And there's a technical difference between diluted and basic. It just refers to the amount of dilution from things that have not yet happened. Basic means all the shares that have been outstanding. Let's divide the total income by the shares. That's basic. But when we look at other rights or obligations that the company has for others to be able to get more shares, this is more conservative, saying out of all the people that could have shares, let's assume they all have shares. And then what would be the earnings per share? So earnings per share basic is what was actually outstanding by way of shares. Earnings per share diluted is assuming the maximum amount of shares that could have been issued that weren't, otherwise they'd be basic. So it adds the other shares that could have been issued and makes the earnings per share lower. So it's seen as a more conservative measure of earnings per share. And on the bottom here are just by way of reference, how many shares were outstanding, in this case for Intel. So that is the income statement for Intel. All right, we'll go back to look at our next statement.